Okay, let's look at financial ratios. We gave you a sneak peek on them in the last video, and let's take a look at some of the issues with ratio analysis. So ratios complement common size analysis, and they allow for deeper comparison through time or between dissimilar companies. So not always are they precisely computed the same, so you have to remember to document and look at the approach or the approach of whose information you're using. So as we look at each ratio, think to yourself, how is it computed? How is the ratio, what is it trying to measure and why? What is the unit value of measurement, because the unit are different depending on the ratio itself. What does the value indicate? What are we really looking for here? And of course, how can we improve the company's ratio? So when you start thinking about ratios and you want to improve them, what do you really need to do for each ratio? So there's a lot of things going on in a ratio that is not apparent when you just get a number. So let's go through a few of these. This is a chart. I like the summary here of all of the different categories. It's broken down pretty well into short-term or solvency liquidity ratios, long-term solvency or financial leverage ratios, asset utilization or turnover ratios, and then of course profitability ratios. We certainly want to be profitable, and then a market value ratio. So how is the market judging us? So we've got 6 different types of ratios here. I'm not going to go through each ratio. I could, but I'm not going to. I think if you read through your book on each ratio, you'll get the gist of each one. It's probably faster than me explaining every one of them to you. Some of it's been covered in managerial accounting as well. However, I'm going to talk about a few things in general about financial ratios, and then we're going to talk about one ratio which pulls in a bunch of different things which will be very useful for you. So before we go further, let's talk about using financial ratios. The most important part that I've talked to you about before is that they're not helpful by themselves. They need to be compared to something. So instead of saying I have a probability of 15.7%, well, that's great, but does everybody have 15.7%, or are there other companies that are better, other companies that are worse? How is that against your own historical average? How is it against your peers? How is it against other industries, etc.? So one thing is to make sure that you're comparing against something else when you use ratios. One is time trend analysis, used to see how the firm's performance is changing through time. So time trend analysis is you could look and say, well, we were profitable at 15.7% this quarter, previously at 12, previously at 10, previously at 8, previously at 5, previously at 3. That's a pretty good trend. Things are moving in the right direction. Or it could be the other way around, is we used to make 40%, now it's 30, 20, and all the way down to 15.7, that would be the wrong trend. So an individual data point is not nearly as impactful as a trend, and ratios are much more a function or a meaningful function when compared over time. So for example, you could say company profits have been increasing over time, but how much is your profitability been increasing as a ratio of your total sales? So you could have much higher profitability in terms of a solid number, but the firm could be growing tremendously, but you could be losing how much profitability per sales dollar you get. So instead of earning $40 or 40% on a sale, now you're earning 15.7% per sale, and but the sales are much higher. So the question is always to compare over time or trends over time, and that will tell you how the company's been doing and how it's likely to do or more likely to do in the future. In addition to trend analysis, we do peer group analysis. We compare similar companies. You can go to Reuters Finance Stocks and get the financial links to compare ratios between companies. Is one way to do it. There's a bunch of other ways to do it. But peer group analysis is to compare different companies in the same industry to say that if one car company is making X number of dollars or percentage profits or whatever it was, then another company should be making similar profits, or if not, why is there a difference between the two? Who's winning, who's losing, and why are they doing that? So it's a good tool for comparison between the two. So financial ratios are very helpful. You can review them peer-to-peer, or you can review them for internally in the company as a trend over time. Either way, they work better than absolute numbers, because the absolute numbers will not reflect company size and not necessarily the nuanced difference that you're looking for, which is, are we still making every profitable dollar that we can, or are we losing the percentage of probability and we're just increasing sales? And so that's a big difference of company.